Where do I even start with today? I mean, I really should be talking about the potential for a war with Iran, but I mean, the ongoing financial crisis pretty much, outstripes that. Maybe not in terms of, well, I don't know. It pretty much is more important at this point. So screw Iran. I'm going to talk about the stock market because today was the worst day for the stock market not just in my entire lifetime, but since 1987. That's a very long time. That's older than a lot of people alive today who are actually trading in this market. Certainly is older than most of the little millennials on Robinhood with their mustache wax and craft beer. And certainly, it's the worst day that pretty much any of the actual floor traders on Wall Street or in Chicago for that matter have seen in their lifetimes, because the guys who were around in 1987 were the yuppies. The yuppie generation, they're not trading anymore. They're retired. They already made their money. They're sitting on their yacht in the Caribbean. And so no one really knew how to handle this. Nobody was expecting it for some reason, even though I hate to keep taking these victory laps, but I've been forecasting this for 2 years. And forecasting is the wrong word because I didn't give a specific date. All I'm just saying is that, hey, you can't be surprised when the next financial crisis comes. And this time, of course, it's sparked by the Wu flu. And we've had so much bad news today about the Wu flu. I can't tell you how many things now are finally being canceled. The MLB is canceled. Spring training is canceled. Major League Soccer. Forgot that existed, but it does exist. Totally canceled. The NHL, National Hockey League, canceled. The NBA, basketball, canceled. NCAA basketball, March Madness, one of the biggest sports events of the year. The whole month of March, it's a big basketball competition between the colleges in the United States. Totally canceled, gone. This is not awesome, baby, as Dick Vitale would say. And the mayor of New York came out today and said, hey, all these places where we hold major gatherings, like Madison Square Garden, of course, home of the New York Knickerbockers, an NBA team. Those places are going to be closed indefinitely for a matter of months. At least I have to give the mayor of New York some credit, because he's saying for a matter of months rather than saying April, which is where all these other places, when they're closing stuff, they're saying, well, we'll have to take a 1-month break, or April or something. That's what the Chinese are saying too. Oh, we should have our factories back up and running by April. BS. This problem's going to persist much longer than April. But again, as I've said, even if it didn't, the financial ramifications are already felt. The bubble has been pricked. The air is coming out. And as we saw today, I mean, again, I'm jumping all over because there's so much news that I have to get to. We saw today perhaps one of the most, I think, important events of this business cycle. Something that I have been, wrestling with over these past few years. There's people who are bearish like me and see the bubble coming tend to be very pessimistic about the Fed's ability and the government's ability to reinflate it this time after last time. Well, the same people who wrongly in 2009 predicted that QE wouldn't be able to postpone the crash and be able to stop the sell-off and everything, are saying now that they don't think that the Fed will be able to accomplish that goal. I'm trying to be a bit more modest and learn from the mistakes of other people like me who were around in 2008 and made a bad call, and perhaps kept shorting even after all the Fed's measures, because they were betting that the Fed was just going to, nuke the dollar by printing so much money at once and injecting it into the market that would cause hyperinflation, which didn't happen because, of course, the inflation was isolated to financial markets. It didn't really make it into the real economy. Ordinary people did not take advantage of any of that printed money. All that money went to rich people who tend not to spend a lot of money. And so that's why, inflation never transmitted, to the regular economy, why we didn't see consumer price inflation to a great degree. And so I've been holding out the possibility that the Fed would be able to do that again, because I don't know necessarily. I wouldn't have been able to predict it probably in 2008 that they were going to be able to pull off what they did. So who knows what they'd be able to pull off this time, even though, there is still the problem that everyone has been highlighting, again, at least everyone who's been bearish up to this point, that the Fed in 2008 and in 2000 had to cut 500 basis points in order to stop the sell-off. And actually in 2008 it was 500 basis points plus quantitative easing, and plus bailing out all the banks. this time around, we already have QE going in the form of not QE and repo, and interest rates were very close to zero to begin with. We barely got off of zero. In fact, raising rates from zero is what initially pricked this bubble, because the air started coming out, and then the Fed had to backtrack and start trying to reinflate it and cut rates again and restart QE. And so here we are today in the face of a new financial crisis. The bubble's now been pricked again by the Wu flu here, and the Fed is out of ammo. They've already got QE going on, and so the only answer is, well, they still have a little bit of room before they get to zero, not that much room, so they can cut to zero, which they haven't done yet, and they can increase QE. Because QE was already going on in the form of repo. And so that's what they chose to do today. The Fed said, screw it, we're just going to, do a massive, liquidity bazooka. They're going to throw as much money as they can at the markets. $500 billion, $500 billion. Okay? That is, just for comparison, about the size of the annual budget of the U.S. military, the largest military in the world. All those wars and things that are going on overseas, all those bombs that the U.S. buys, all those aircraft carriers. Yeah, the costs of that every year is about what the Fed injected into financial markets today. This is the liquidity that they injected into the financial system to try and essentially bail out the banks. And and all the people who are deeply in debt right now, who can't pay their loans. And you must think, and they also committed, by the way, they committed to doing this every day indefinitely, I think. It'll probably be indefinite. So this is going to keep going. This is every day we're going to get another $500 billion. And you would think, wow, that must have really, shot markets up, because, before that we were limit down today again. I didn't mention that yet. This is the second day of the week that the stock market was limit down, meaning they hit 7% and triggered a circuit breaker, they call it, which pauses trading for 15 minutes. And that's to try and get people out of the mood of selling and to get them to start buying again. Well, what happened after that 15 minutes expired? Well, stocks really didn't go up at all again. They were hoping they would go up, but in fact, we ended up today, I think, closing on the lows. Certainly sold off into the close. Actually, yeah, definitely closed on the lows, because did I mention down 10%, the worst day since, of course, the Dow was down 10%. The S&P was down maybe 9.7, I think, 9.6. And so this is pretty catastrophic. The Fed's liquidity bomb, I got off topic again. The Fed's liquidity bomb, getting back to that, made some impact on the market. There was a huge spike right after they announced it, which lasted for maybe 15 minutes before we got right back down to where the markets were before the Fed made their big announcement. So this had no impact. This was a dud, okay? It went poof. There you go. Here's $500 billion. Oh, thanks. That was the market's response. It wasn't, oh, thank you, sir. Please, may I have another? No, the markets were not very thankful for this at all. They did not respond in kind to the Fed's announcement. And so this is a major turning point in monetary history because, we had the Fed, essentially fire a monetary bazooka at this market, and it had no effect. So, the concerns that some people have been having about the efficacy of monetary policy and whether or not the Fed and other central banks would really have any power this time around in impacting the market, that suspicion seems to have, bore fruit because the Fed really didn't have an effect today. And if, monetary policy is dead, if that no longer has any effect, well, then there's no floor to this market, because the only thing that saved us last time, the only thing that has been propping up this market the whole time has been hope that the Fed could save us. That was the idea. Don't fight the Fed. That has been the law of markets for the last few years. Just, whatever the Fed says. If the Fed says, we're cutting rates, well, that means stocks are going up. If the Fed says we're raising rates, that means stocks are going down. That has been, what's happened. The Fed governor has been essentially, the Fed board really has been a Politburo planning the level of the stock market. And if, that air of control, if the perception of control is broken now because they failed to accomplish their goals, because they look like, frankly, impotent fools, the impotent fools that they have always been, but now they're being exposed to the average investor. That's a very, very, very negative, very, very bearish sign for the markets. And so now that the Fed has, announced this, what, what else can they do? I mean, I really don't know where we go from here. What, a stimulus package through Congress? That doesn't do anything. Send everyone in the country a check for $500. That's going to save us from a financial calamity. Because I mean, the repo here is, in effect, I mean, it's it's not a direct bailout, but I mean, it's pretty close. It's the closest thing to a bailout of these individual companies than, aside from a bailout itself. I guess that's the only thing left they can try is just, buying up the notes for all these indebted companies. Essentially intervening in the corporate bond market and in the banking sector and just doing another round of TARP, I guess, that sort of thing. And, I don't mean to sound speechless, but I am. This is a remarkable day. It's a day that I think that observers of monetary policy are going to remember for the rest of their lives. Today is the day that the rest of the world, those of us outside of this, I guess you could say the bubble of monetary dissidence, this is the day that they looked up and at Emperor Powell and saw that he had no clothes. Now, you want to know something really scary? If you look at a chart of market cap to GDP today, you're going to probably, soil yourself, to put it mildly, because we, in February, when everyone was saying how great, the stock market was and how everyone should go out and buy stocks, we were at about 158% market cap to GDP. That means that the value of all stocks was, equivalent to the annual output of the U.S. economy times 1.58. It was, in fact, the highest valuation for stocks in history relative to GDP. The second closest was in 2000 during the massive, unprecedented NASDAQ bubble, in which market cap reached 150% to GDP. Everyone agreed that was, bad. And just so you know, in 2008, market cap to GDP peaked around 110%, 112%. So just to give you a relative idea of how overvalued the stock market is right now, or was going into this crash, and then you look and see that this week, after most of the selling, not counting today, but after I think up to yesterday, we're only at 133% market cap to GDP. So in other words, we haven't lost that much. The historical average, if you look at the 80s and 90s, is between, like 50 and 75%, below 100% market cap to GDP. And, like I said, we're still way, way, way overvalued relative to 2008 when that crash started. In 2008, I think that stocks bottomed around 50% market cap to GDP, and that was with the Fed, doing everything it could. And actually accomplishing in stopping the sell-off at some point in March. But here we are. The Fed fires a bazooka of monetary heroin at the market, and it does nothing. So, does that mean that we're going below 50% market cap to GDP? I don't know. It certainly looks, the way that you look at the chart, it looks like there's a lot of air down there. And of course, as I've explained so many times before, and I will not do it again, just for the sake of those who listen regularly, our economy is based entirely off of stocks being high. That's what keeps people happy and complacent, and encourages them to keep taking it to run up credit card debt and to take out loans to buy houses that they can't really afford and to buy brand new cars every year. It's because the stock market's good. It's because people who have 401ks feel like they're getting richer every year. Well, if all that wealth suddenly evaporates, people like just now, even with again, I'm leaving the coronavirus aside as far as this is concerned. So, the coronavirus is a whole different story that makes this much, much worse. But just with the fall of the stock market, people are going to stop spending all that money, which is good. That's good. That means that people are going to make good financial decisions. But GDP, as the measure, will collapse. And, as so many of us have been predicting, the greatest debt bubble in history is going to lead to, one of the deepest depressions in history. And, by the looks of it, not just judging by market cap to GDP, but by the inefficacy of monetary policy, it would seem as though that this is going to be far worse than the Great Recession, as it's called. I think that things are going to go down, and at best, what the Fed and the government are going to be able to do is stall the economy. They're going to perhaps prevent it from going low, but they're going to prevent it from going higher ever again too. And so you'll end up with a situation like the Great Depression, in which the economy never could reset properly, in which the government essentially stifled the markets as best they could, and kept us under malaise for a decade. Now, something else to consider now with the death of monetary policy is that if the Fed is pissing away this money, and it's not making stocks go up, and it's not having the desired effect, and people are not taking the Fed's actions to mean that there are greener days coming ahead, well, then what happens to all that money? Where does it go? Does it go into higher asset prices? Or if it is unable to drive asset prices up, does this lead people to believe that the Fed is going to just keep printing money forever, to try in vain? Because if you think about it, the value of the dollars that they're putting in, if they're unable to have much effect, well, that means that the Fed has to print more money to get the same effect. Well, that seems to me like plenty of speculators would look at that and go, very bearish for the dollar. Could this mean then that we're finally going to have that inflation that so many people predicted in 2008 because of QE? Because back then the reason why inflation didn't happen is because people respected the efficacy of the Fed, because the Fed had efficacy, because monetary policy was trusted. But now it doesn't look like that there is much trust in monetary policy. And so that'll be something very interesting for me, because I've never experienced inflation in my lifetime. The last time we had much inflation in the United States was the early 80s. And then, of course, thankfully, the great Paul Volcker crushed that like a little bug. But he had to do so by, of course, raising interest rates to double-digit levels. It was incredible to think what that could have happened, that happened back then. But here in the United States, we could never do that again. Interest rates have to remain at zero forever because there's so much debt. Things will collapse. We won't have a society left. Everyone will be bankrupt. And by everyone, I mean the wealthy, the well-to-do, the government, all the folks with power that have the control out of this economy. And so, of course, even if inflation does break out, the Fed can't raise interest rates to try and stop it. So that seems to be the risk now, because if the Fed is unable, again, if monetary policy is not having the desired effect of pushing up asset prices, well then you're going to see the value of the dollar fall. So with that said, if you folks gain anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. And if you haven't already, please do subscribe, because I do upload every day and I'd hate to have you miss one. So I'll see you folks back here tomorrow.